Okay, let's unpack this. Navigating the world of business ownership means understanding the financial choreography between you, the owner, and the entity you've created. Specifically for C corporations, well, that relationship has some fascinating and complex tax implications.
It really does.
Today, we're taking a deep dive into those crucial transactions, looking at how money and assets flow between you and your C corp and, how the IRS looks at it all.
It's an absolutely critical area, touching on the entire life cycle of a business from its very first day to how profits get shared and even what happens when things wind down.
Right.
Our goal here is pretty simple but vital: to cut through the complexity of the source material you've provided, pulling out the most important nuggets of knowledge so you can understand the core concepts driving the tax treatment.
Get the inside scoop, basically.
Yeah, think of it as getting the inside scoop on the tax dance between a C Corp and its owner.
All right, let's jump right in at the starting line. Forming a C corporation. This is where you take assets or maybe cash you own and put them into this new corporate entity in exchange for stock. Here's where it gets really interesting, though. Doing this often doesn't trigger an immediate tax bill, even if the assets you contribute have, gone way up in value. What's the magic behind that?
Well, that tax-free initial step, that's thanks to a specific section of the tax code, IRC Section 351.
Section 351.
The core purpose of 351 is essentially to allow people to incorporate an existing business or start a new one by moving assets into that corporate structure without the immediate penalty of taxation on any built-in gains.
So it helps businesses get started or change form without a big tax hit right away.
Exactly. Imagine you've built a successful sole proprietorship. You've got valuable equipment, maybe some intellectual property. It's got a low tax basis, but a high market value. Section 351 lets you move those assets into a formal corporate structure. Maybe you need it for growth or fundraising or just limiting liability without having to write a huge tax check just for changing the legal box the assets are in.
That sounds incredibly useful, but it's not a blank check, right? You mentioned it's not automatic.
That's right.
What are the crucial conditions, the hoops we have to jump through for this tax-free treatment to apply?
That's right. There are two vital requirements laid out in the source material. The first one is all about control.
Control.
Immediately after the exchange, like right after you've transferred the property and gotten stock back, the group of people who contributed property must collectively own at least 80% of the corporation's voting stock.
Yeah, 80% voting stock.
And importantly, it's not just voting stock. They also need to own at least 80% of all other classes of non-voting stock, too.
Ah, so 80% of everything, basically.
Pretty much. This ensures that the transfers, the people putting the core assets into the business, retain clear control right after the formation. It's about continuity of control.
Okay, so ownership and control immediately after the transfer. That's step one. What's the second condition?
The second requirement is that the transfer of property must be solely in exchange for stock of the corporation.
Solely for stock.
Yeah, this is where things can get a little tricky. If you receive anything else back in that exchange, in addition to stock, something the tax code calls boot, well, that can potentially mess up the pure tax-free picture. It might trigger recognized gain.
Boot. Okay, we'll definitely need to circle back to that.
We will. But the fundamental requirement for full tax deferral under 351 is that you're just swapping one form of ownership, like direct ownership of assets, for another indirect ownership through stock in the corporation that now holds those assets.
Okay, so if those two conditions are met, the 80% control test and receiving only stock for your property, the shareholder generally avoids immediate tax. That's great for the shareholder. But the corporation now owns these assets, like a building or equipment.
Right.
What tax basis does the corporation get in that property? This is super important, right? Because that basis is what the corporation uses for future depreciation or figuring out gain or loss if it sells the asset later.
Absolutely. The corporation's basis is a critical piece of the puzzle. The general rule, as outlined in the source, is that the corporation's basis in the property it receives in a Section 351 transaction is the greater of two amounts.
Greater of two. Okay.
The first amount is essentially a carryover of the shareholder's tax investment. So it's the shareholder's adjusted basis, think net book value or tax cost in the property they contributed.
Okay, their cost.
But you add to that any gain that the shareholder actually had to recognize on the transfer.
Wait, why does the shareholder recognizing gain bump up the corporation's basis? That seems counterintuitive.
Yeah, it's a smart question. It's designed specifically to prevent that exact amount of gain from being taxed twice.
Ah, Right.
See, if the shareholder did have to pay tax on some gain during formation, maybe because they got boot, or maybe liabilities they transferred exceeded their basis, which we'll get to, the corporation gets to step up its basis by that same amount.
So the corporation gets credit for the tax the shareholder already paid on that bit of gain.
Exactly. It ensures the gain recognized by the shareholder isn't potentially taxed again when the corporation later uses or sells the asset. So that's the first number, shareholders' basis plus their recognized gain. The second amount the corporation compares this to is simply the amount of debt on the property that the corporation assumes.
Just the debt itself.
Right. So the corporation's basis is the greater of shareholders' carryover basis plus recognized gain, or the amount of liabilities it took on related to that property.
Got it. So they look at the shareholder's tax cost, adjusted for any tax the shareholder paid, versus the debt the corporation is taking on, and they take the higher number as their starting basis for depreciation and future sales.
Precisely.
Is there like a safeguard against people trying to game this, like putting assets with built-in losses into the corporation?
Yes, that's a very important point the source highlights. There is a specific limitation designed to prevent exactly that, transferring built-in losses.
Built-in losses, meaning the basis is higher than the fair market value.
Exactly. If the total adjusted basis of all property contributed by that control group, remember, the 80% group collectively exceeds the total fair market value of that property at the time of transfer.
So overall, they put in stuff worth less than its tax basis.
Right. If that happens, the corporation's basis in the property is limited to the aggregate fair market value at the time of the transfer.
Why does the IRS care about that? What's the potential abuse there?
Well, without this rule, you could contribute property with a high tax basis, but a low current market value property holding a built-in loss. If the corporation then immediately sold that property, it could realize a tax loss, a loss the shareholder might not have been able to fully use personally due to various limitations.
Shifting the loss to the corporation where it might be more usable.
Precisely. So this rule prevents that strategy. It forces the corporation to take a basis equal to the lower fair market value if the overall transfer involves assets worth less than their total basis. You can't just transfer losses into a corporation tax-free like that.
Okay, makes sense. Let's flip back to the shareholder side then. They put property in, got stock back. How do they figure out their gain or loss? I know in tax, there's always this distinction between the gain you realized versus the gain you actually recognized and pay tax on now.
That distinction between realized and recognized gain is absolutely fundamental in tax, especially in these types of transactions. First, you always calculate the realized gain or loss. This is basically measuring the total economic change in your position from the deal.
How do you calculate that?
The source gives us the formula. You take the fair market value of the stock you received,
Okay, value of stock.
plus any liabilities the corporation assumed on your behalf, because being relieved of debt is like receiving economic value, right?
Makes sense.
Plus the fair market value of any boot you receive, that non-stock stuff we keep mentioning.
Got it. Stock value plus debt relief plus boot.
From that total value received, you subtract your adjusted basis, your tax cost, in the property you contributed. The result is your realized gain or loss on the exchange. It's the economic profit or loss.
So that's the potential profit. But under IRC 351, if those two conditions, the 80% control and solely for stock, are met, the recognized gain, the amount you actually pay tax on right now, is zero, even if your realized gain is massive.
Precisely. That is the core benefit, the magic, of Section 351. If you meet those requirements, your recognized gain is zero. The tax on your realized gain isn't eliminated forever, mind you.
No, it's deferred.
It's deferred. It gets built into the basis of the stock you received, which means you'll eventually deal with that gain, likely as a capital gain, when you sell the stock down the road. But for now, no tax.
Okay, deferred, not eliminated. Got it. Now, let's tackle boot. You mentioned it can mess things up. What exactly is boot, and when does receiving it trigger that recognized gain you talked about?
Right, boot. Boot is essentially anything you receive in the Section 351 exchange other than the qualified stock of the corporation you're forming.
Like what?
The source specifically lists things like cash withdrawn during the transaction or receiving debt securities from the corporation, like bonds, instead of just stock. Those are common examples of boot.
And if you get boot,
If you receive any boot, it does trigger recognized gain. The tax-free ride isn't completely derailed, but you have to recognize some gain now.
how much gain? Is it all the gain or just the value of the boot?
Good question. The amount of recognized gain triggered by boot is the lesser of two amounts. Either your total realized gain on the transaction or the fair market value of the boot you received.
Lesser realized gain, or FMV, of boot.
Exactly. So the boot acts as a ceiling on the recognized gain. You won't pay tax on more gain than you actually realized overall. And importantly, you won't pay tax on more gain than the value of the non-stock stuff, the boot that you actually took out of the deal.
So it's like taking some chips off the table during formation, and the tax system makes you pay tax on those chips, but only up to your total profit.
That's a great way to put it. You're taxed on what you extract up to the limit of your underlying gain.
Okay. We talked about liabilities the corporation assumes. You said they generally reduce the shareholder's stock basis, but aren't usually boot.
Correct.
But what happens if the debt the corporation takes on is more than the tax basis of the property it's attached to? Like contributing a building with a huge mortgage, but a very low tax basis from depreciation.
This is a crucial exception. While liabilities assumed are generally not treated as boot for that solely for stack test, the source is clear. The amount of liabilities assumed by the corporation that exceeds the total adjusted basis of all the assets the shareholder transferred does generate recognized gain for the shareholder.
So if the debt relief you get is greater than your tax cost in the assets you gave up, that excess debt relief is taxable gain right then and there.
Exactly. The calculation is pretty straightforward. You take the total adjusted basis of the assets you transferred, and you subtract the total liabilities the corporation assumed related to those assets. If the result is negative,
That negative number is your taxable gain.
that negative amount represents the excess liabilities, and that excess liability amount is treated as recognized gain for you, the shareholder.
Okay. Does that gain affect the shareholder's stock basis too?
Yes, it does. The source notes that this recognized gain from excess liabilities also increases your stock basis. Think about it. If liabilities reduce basis, but taking on excess liabilities triggers gain, which you pay tax on, that gain needs to increase basis to offset the excess liability reduction. It essentially prevents you from ending up with a negative basis in your stock, which the tax system generally doesn't allow.
Right. Keeps the basis at 0 or above.
It's another rule preventing potential tax schemes. You're effectively treated as having cashed out the difference between the large debt you were relieved of and your lower basis in the property.
Okay, that covers property contributions and the complexities there.
Yeah.
What if someone gets stock not for property, but for providing services, like the lawyer who helped set up the corporation or the accountant?
That's treated fundamentally differently under the Section 351 rules. The source is very clear on this. Stock received for services rendered is not considered property for Section 351 purposes.
So it doesn't get tax-free treatment.
Nope. The fair market value of that stock received for services is recognized by the shareholder as ordinary income immediately upon receipt.
Ordinary income, like getting paid salary.
Exactly. It's taxable to them right away, just like earning a salary or getting a bonus in stock. No deferral there.
And how does that affect the 80% control test we talked about earlier for the property contributors?
This is a critical detail. A shareholder who contributes only services and gets stock only for those services is not counted as part of the 80% control group when you're testing if the property transfers met the Section 351 requirements.
So the service provider is kind of outside that test.
Right. Now, if someone contributes both property and services, they are included in the control group because of their property contribution. But the portion of the stock they receive that's specifically allocated to their services is still taxed to them as ordinary income. Only the stock received for property gets the potential Section 351 deferral.
Okay, let's try to bring all these pieces together now. How do we calculate the shareholder's final tax basis in the stock they received? This is their tax cost, their investment amount going forward for when they eventually sell that stock.
Right. The stock basis calculation integrates all these elements we've been discussing. The source provides a pretty clear formula to follow. You start with
Okay.
any cash contributed by the shareholder. Pretty simple.
Cash in.
Plus, the fair market value of any services contributed. Remember, they paid ordinary income tax on this value, so it becomes part of their tax investment, their basis in the stock.
Right. Tax paid means basis.
Plus, the adjusted basis, or net book value, of any non-cash property contributed. That's their original tax costs carrying over.
Okay. Property basis in.
Plus, any gain recognized by the shareholder on the transfer. This could be gain from receiving boot or gain from those excess liabilities. Since they paid tax on this gain, it gets added to their basis.
Gain recognized adds to basis. Makes sense.
Then you subtract the stuff that reduced their net investment. So, minus the fair market value of any boot received by the shareholder. If they took cash or other non-stock value out, that reduces their investment in the stock.
Boot received reduces basis.
And minus any liabilities assumed by the corporation that were tied to the contributed property. Being relieved of debt also reduces your net investment amount in the stock you receive.
Liabilities assumed reduce basis.
Okay.
So cash plus FMV services plus NBV property plus gain recognized FMV boot liabilities assumed stock basis.
That's the formula. It logically pulls together all the inflows and outflows of value and tax cost.
The source also had a helpful little passkey rule of thumb about basis based on whether the event was taxable or not.
Yes, that's a great general principle that pops up all over tax law. For a taxable event like receiving that stock for services, or maybe a constructive dividend we might discuss later, your income is generally the fair market value, FMV, of what you received, and your resulting basis in that item is also the FMV. You paid tax on the value, so that value becomes your new basis.
Taxable FMV basis.
Right. And for a non-taxable event, like a successful tax-free Section 351 formation, or maybe a regular stock dividend, you generally recognize no income, and your basis is typically based on net book value, NBV, meaning you carry over the old basis from the property you gave up or the stock you already own.
Non-taxable IPSHR NBV basis carryover.
Exactly. That NBV-FMV distinction based on taxability is a really useful shortcut for understanding basis adjustments.
Formulas are one thing, but seeing them work is better. Let's run through those illustrative examples provided in the source material to see how these rules play out. Let's start with Tim.
Okay, the Tim example is a classic for showing how liabilities assumed can impact basis and, crucially, trigger gain when they exceed basis. Tim contributes a building. His basis in the building is $100,000. Its fair market value is much higher, $500,000.
Okay, $100 K basis, $500K FMV.
But here's the key.
Yeah.
The building has a $225,000 mortgage that the corporation assumes.
So the liability, $225K, is way more than his basis, $100K.
Exactly. This immediately flags the liabilities in excess of basis rule. Since the $225,000 liability is greater than Tim's $100,000 basis by $125,000, $225,000, Tim must recognize a $125,000 gain on the transfer.
Taxable gain right there, $125,000.
Yep. Now, let's apply our full stock basis formula. Start with property basis, $100,000, plus gain recognized, $125,000, minus liability assumed, $225,000.
$100,000 plus $125,000, $225,000, that equals zero.
Exactly. So Tim's basis in the stock he receives is zero. The recognized gain he paid tax on effectively bumps his basis back up to zero, preventing that negative basis situation.
Okay, Tim has zero basis stock. What about the corporation's basis in that building it just received?
Good question. Remember the corporation's basis rule? It's the greater of the shareholder's adjusted basis plus any gain the shareholder recognized or the amount of debt assumed.
So Tim's basis, $100 K, plus his recognized gain, $125K, is $225K.
Right. And the debt assumed was also $225,000.
So they're equal in this case.
They are. So the corporation's basis in the building is $225,000. That's the amount the corporation will use to calculate its future depreciation deductions on the building. Notice the step up the corporation gets a basis higher than Tim's original $100 K, reflecting the gain Tim had to recognize.
Makes sense. Okay, next example, Alento. Alento contributes a mix of assets, equipment, a building, inventory. Total basis is $140,000. Total FMV is $260,000. Alento gets 100 shares of stock.
Okay, first let's figure out Alento's realized gain. The value received is assumed to be the value of the stock, which reflects the FMV of the asset, so $260,000, minus the basis in the property contributed, $140,000.
$260K, $140K equals $120,000 realized gain.
Right, $120,000 economic profit on the exchange.
But the example states the recognized gain is zero. Why is that, given that $120,000 realized gain?
Because the conditions for Section 351 were presumably met. We assume Alento was part of a control group owning 80% or more right after, and crucially, the example implies Alento received solely stock in exchange for the property.
No boot, no mention of liabilities.
Exactly. No boot received and no mention of liabilities assumed exceeding basis, or any liabilities at all. So even with that $120,000 economic profit, the tax is deferred under Section 351. Recognized gain is zero.
So how does that zero recognized gain affect Alento's stock basis and the corporation's asset basis? This seems like the clean, non-taxable scenario.
It is. For Alento's stock basis, start with the basis of assets contributed. $140,000, plus gain recognized, 0, minus boot received, $0, minus liabilities assumed.
So $140,000. Olinto's stock basis is just the carryover basis of the assets.
Correct. And for the corporation's basis in the assets it received, it's the transfer's basis, $140,000, plus any gain recognized by the transfer, 0.
The corporation's basis is also $140,000.
Also $140,000. This is a pure carryover basis scenario. The $140,000 basis simply transfers from the shareholder in the assets to the corporation in the assets and to the shareholder in the stock. No step up because no gain was recognized.
Okay, clear contrast to Tim. Now, finally, the Gertie example. Gertie contributes assets, same numbers as Olinto. $140,000 basis, $260,000 FMV, gets 100 shares. But this property is subject to a $60,000 mortgage, which the corporation assumes.
Okay, so Gertie's realized gain calculation is identical to Olinto's. $260,000 value received, stock, minus $140,000 basis in assets equals $120,000 realized gain.
Right. And again, like Olinto, the source says the recognized gain is 0. It specifically notes no boot received liabilities do not exceed basis. This seems key.
Absolutely key. The $60,000 mortgage assumed by the corporation is less than Gertie's $140,000 basis in the assets transferred.
Unlike Tim's situation.
Right, because the liability, $60K, is less than the basis, $140K. The liability is in excess of basis. Rule that triggered gain for Tim does not apply here. And since no other boot was received, and we assume the 80% control test was met, the entire $120,000 realized gain is deferred under Section 351. 0 recognized gain.
Okay, 0 recognized gain for Gertie too. But how does that $60,000 liability impact Gertie's stock basis? This is where we should see the difference from Olinto, even though both had 0 recognized gain.
Exactly. This example perfectly illustrates the impact of liabilities assumed when they don't exceed basis. Let's use the stock basis formula again for Gertie. Start with basis of property contributed, $140,000, plus gain recognized, $0, minus boot received, $0, minus liabilities assumed by the corporation, $60,000.
$140,000, $60,000, that's $80,000.
Gertie's stock basis is $80,000.
Yeah, so compare that. Olinto, with no debt, had a $140,000 stock basis carryover. Gertie, with 60K stat assumed, has an $80,000 stock basis. The liability assumption directly reduced the stock basis.
Precisely. Liabilities assumed by the corporation reduce the shareholder's stock basis because they represent a reduction in the shareholder's net investment. If those liabilities happen to exceed the asset basis, then they trigger gain, and that gain bumps the stock basis back up, often to 0, like Tim. But if they don't exceed basis, they just reduce the stock basis dollar for dollar.
And the corporation's basis in the assets from Gertie.
Still, the transfer's basis, $140,000 plus gain recognized, $0. So the corporation takes a $140,000 basis in the assets, same as in the Olinto case, assuming no overall built-in loss limitation. These examples really nail down how liabilities and recognized gains sculpt those basis numbers for both sides during formation.
Okay, fantastic clarification on formation. So the corporation is formed, assets are in place, hopefully it's making money. Now the owners want to get some of that profit out. This brings us to distributions, and this is where C Corp taxation can feel particularly, well, unique.
Unique is one word for it, yeah. Often feels complex.
Is any money coming from the corporation to a shareholder automatically considered a taxable dividend?
That's a really fundamental question, and the answer is a crucial distinction for C corporations. No, not automatically. A distribution of cash or property from a C corp to its shareholders is defined as a taxable dividend only to the extent it comes out of the corporation's earnings and profits, or E&P.
E&P. Okay, that sounds important.
It's the absolute key concept here. E&P determines whether a distribution is a fully taxable dividend, or maybe a tax-free return of your original investment, or maybe even a capital gain.
So E&P is the pool that dividends come from, but E&P isn't exactly the same as the retained earnings number you see on the accounting balance sheet, is it?
You're spot on, it's not the same. E&P is a specific tax concept. It starts with the corporation's taxable income, but then it gets adjusted for a whole bunch of items that affect the corporation's actual ability to pay dividends, but don't necessarily show up in taxable income calculations.
Like what kind of adjustments?
Oh, things like adding back tax-exempt interest income the corporation received, or adding back certain deductions that don't require cash outflow, like the dividends received deduction, or subtracting non-deductible expenses like federal income taxes paid, or penalties, or excess charitable contributions. It's meant to be a truer measure of economic ability to pay.
Okay, so it's a tax calculation. How do we figure out if a specific distribution is coming from this E&P pool? You need to know how much E&P there is.
Exactly. You need to track two components of E&P. Current E&P, which is calculated for the current tax year, and accumulated E&P, which is the total undistributed E&P from all prior years rolled forward.
Current and accumulated.
Right. And the source material lays out these general netting rules for how current versus accumulated E&P interact to determine dividend status. Understanding these rules is really vital.
Okay, let's walk through those netting rules. They sound like the heart of this.
They really are. They can feel a bit counterintuitive sometimes, but here's the basic principle. Distributions are always considered to come from current E&P first and then from accumulated E&P. Generally, current and accumulated E&P are not netted together except in one specific situation.
Okay, current first, then accumulated. No netting usually. What's rule number 1?
Rule 1. If both current E&P and accumulated E&P are positive numbers.
Both positive. Easy case.
Easiest case. Distributions are treated as taxable dividends to the extent of the total combined E&P, current plus accumulated. Plenty of E&P to cover the distribution as a dividend.
Makes sense. What if both are negative? The company's losing money currently and lost money historically.
Rule 2. If both current E&P and accumulated E&P are negative, distributions are not dividends at all.
Not dividends. What are they then?
They're treated first as a tax-free return of capital, reducing the shareholder's stock basis. If basis hits zero, any further amount is capital gain. But the key is no dividend income because the corporation has no pool of taxable profits, current or past, to distribute from.
Okay, no E&P, no dividend. Now for the mixed cases, what if current E&P is positive, but accumulated E&P is negative, like the company turned profitable this year after years of losses?
Rule 3. If current E&P is positive and accumulated E&P is negative, distributions or dividends only up to the amount of the positive current E&P.
Only the current E&P.
Yes.
Oh, yeah.
This is where you really see that no netting principle. The negative accumulated E&P from prior years does not offset or reduce the amount of dividends that can be paid out of the current year's profits. That positive current E&P creates dividend income for the shareholder regardless of past losses.
Interesting. So current profit makes dividends, even if the overall history is negative. Okay, what about the flip side? Current E&P is negative, losing money this year, but accumulated E&P is positive, had profits built up from the past.
Rule 4. This is the only scenario where the two E&P accounts are netted.
Ah, the exception.
Yes. If current E&P is negative and accumulated E&P is positive, the two amounts are netted together as of the date of the distribution. Distributions are dividends only if that net amount, positive accumulated E&P minus the pro rata portion of the negative current E&P up to that date, is positive.
You combine them.
You combine them. If the net E&P after considering the current year's loss is zero or negative, then distributions made during that year are not dividends. They'd be treated as return of capital, capital gain. This netting acknowledges that a loss in the current year can effectively erode the previously accumulated profits that were available for distribution.
Okay, that clarifies how you figure out the total potential dividend amount based on the E&P balances using those 4 rules. Now, what's the order if the corporation distributes more cash than it has in total E&P, current plus accumulated? Where does that excess amount come from tax-wise for the shareholder?
This is a really crucial sequence the source lays out. It determines exactly how each dollar of the distribution is taxed to the shareholder. It happens in layers. Layer 1. The distribution is first considered to come from current E&P. This portion is a taxable dividend to the shareholder. It reduces the corporation's current E&P, but importantly, it does not affect the shareholder's stock basis.
Layer 1. Current E&P equals taxable dividend, no basis impact.
Layer 2. After all current E&P is used up, the distribution is next considered to come from accumulated E&P. This portion is also a taxable dividend to the shareholder. It reduces accumulated E&P, and again, no effect on the shareholder's stock basis.
Layer 2. Accumulated E&P, taxable dividend, still no basis impact.
Layer 3. If the distribution amount is still greater than the total of both current and accumulated E&P combined, the excess portion is treated as a non-taxable return of capital.
Non-taxable return of capital. Does this affect basis?
Yes, it does. This amount reduces the shareholder's tax basis in their stock, dollar for dollar. Think of it like getting back some of your original investment tax-free before you've made a taxable profit on it.
Layer 3. Excess over E&P, return of capital, non-taxable.
Yeah.
Reduces basis. Okay.
Layer 4. If the distribution is so large that it completely exhausts all the E&P, current and accumulated, and it completely reduces the shareholder's stock basis all the way down to $0.
Basis is now 0. What happens to any more cash?
Any remaining distribution amount beyond that point is then taxed as a capital gain. typically long-term capital gain if they've held the stock long enough. This occurs because once your basis is zero, any further cash you receive is pure profit above and beyond your entire tax investment.
Layer 4, excess after basis, capital gain, taxable.
Wow, okay.
Yeah.
That four-layer waterfall is key. It's absolutely fundamental to C Corp distributions.
What about preferred shareholders versus common shareholders? Do their dividends follow these same E&P rules? They
No.
usually get paid first.
They do get paid first. For the preferred shareholder receiving the money, their distributions are generally always treated as dividend income up to the amount of their fixed preference, assuming the corporation has sufficient E&P overall. The intricate current accumulated allocation rules are less critical for their tax treatment. They expect a dividend return.
So preferred gets paid, likely treated as dividend income.
Right. They have priority on the E&P. Common shareholders are the residual owners. They only receive distributions out of whatever E&P remains after any preferred dividends for that period have been satisfied. And their distributions are then fully subject to that four-layer waterfall based on the remaining current E&P, accumulated E&P, basis recovery, and capital gain rules.
Okay. These E&P allocation rules, especially with the netting and the layers, can definitely get tricky. Let's use the examples from the source to make this more concrete. First, Julie Corporation. Starts with $20,000 of accumulated E&P and generates $25,000 of current E&P during the year.
Okay, so Julie Corporation has a total E&P pool of $45,000 available for the year. $20K accumulated plus $25K current. The source shows how the taxability changes depending on how much Julie actually distributes.
Right. What if Julie distributes $25,000?
Since $25,000 is less than or equal to the current E&P of $25,000, the entire $25,000 distribution comes from current E&P, layer 1. So the whole $25,000 is a taxable dividend.
Okay, easy enough. What if Julie distributes more, say $40,000?
All right, $40,000 distribution. We apply the layers. The first $25,000 comes from current E&P, layer 1, and is a taxable dividend. That uses up all the current E&P.
Okay, $15,000 of the distribution left to account for.
Right. The next $15,000 comes from accumulated E&P, layer 2, since there's $20,000 available there. So that $15,000 is also a taxable dividend.
$25K plus $15K equals $40K total taxable dividend. The whole distribution is covered by E&P.
Exactly. Now, what if Julie distributes $50,000?
Okay, $50K distribution. Layers again. First, $25K from current E&P, taxable dividend.
Yep. Next, $20K from accumulated E&P, taxable dividend. That uses up all the accumulated E&P.
So far, $25K plus $20K plus $45K is a taxable dividend, but the distribution was $50K. There's $5 left.
Right. That final $5,000, $50K total, $45K from E&P, is in excess of all E&P, so it falls into layer 3. It's a non-taxable return of capital.
And that $5,000 reduces the shareholder stock basis.
Precisely. Reduces their basis by $5,000. If, hypothetically, their basis was only $3,000 before this distribution, then $3,000 would be return of capital, reducing basis to zero, and the remaining $2,000 would fall into layer 4 and be taxed as capital gain. This Julie example clearly shows the waterfall. Current E&P, then accumulated E&P, then basis, then capital gain.
Okay, that makes sense for a single distribution. Now for the more complex one, Linda Corp. Linda Corp starts the year with $10,000 accumulated E&P and earns $15,000 current E&P during the year. But Linda makes 4 separate cash distributions of $7,500 each, $30,000 total, on different dates throughout the year.
Right. This example highlights the specific allocation rules when you have multiple distributions within a single year and you have positive current E&P.
What's the rule here?
The source explains 2 key things happen. First, the current E&P for the entire year, $15,000, is allocated pro rata across all distributions made during the year, regardless of when they were made. Second, the accumulated E&P, $10,000 at the start of the year, is applied chronologically to the portion of each distribution not covered by that pro rata share of current E&P, hitting the earliest distributions first until it runs out.
Okay, let's break that down. Linda has $15,000 current E&P and paid out $30,000 total, $7,500 by 4. So the current E&P covers exactly half, $15K, $30K of the total amount distributed.
Exactly. That means 50% of each $7,500 distribution is deemed to come from current E&P. So $3,750 from each of the 4 distributions, 7,550%, comes from current E&P. That portion is a taxable dividend, layer 1.
Okay, $3,750 taxable dividend for each of the 4 payouts, sourced from current E&P. What about the other $3,750 from each payout? That's $15,000 total remaining.
Right.
$3,750 by 4. Where does that come from?
Now we look to the accumulated E&P, which was $10,000 at the start of the year. And we apply this chronologically to that remaining $3,750 portion of each distribution.
Chronologically. Okay, first distribution, $7,500 total. $3,750 was from current E&P taxable. The remaining $3,750 needs a source.
We have $10,000 accumulated EMP available, so that $3,750 comes from accumulated EMP. Layer 2, it's also a taxable dividend. The first distribution is fully taxable, $3,750 plus $3,750. Accumulated EMP remaining is now $10,000. $3,750 needs a source. We have $6,250 accumulated EMP left. So that $3,750 comes from accumulated EMP layer 2 again, also a taxable dividend. The second distribution is fully taxable. Accumulated EMP remaining is now $6,250. $3,750 needs a source.
Right. Third distribution, $7,500 total. $3,750 from current E&P taxable. Remaining $3,750 needs a source.
Now, we only have $2,500 of accumulated EMP left. So $2,500 of that remaining $3,750 comes from accumulated EMP. Layer 2, taxable dividend, that uses up all the accumulated EMP.
So $3,750 portion, $2,500 from AMP, current and accumulated are both exhausted, so it falls into layer 3. It's a non-taxable return of capital that reduces the shareholder's stock basis by $1,250.
Okay. Third distribution is part dividend, part return of capital. Now, the fourth distribution, $7,500 total. $3,750 from current EMP, taxable dividend. Remaining $3,750 needs a source. We look for accumulated EMP. There's none left. So this entire remaining $3,750 falls into layer 3. It's entirely a non-taxable return of capital, further reducing the shareholder's stock basis.
And if their basis was already low?
If their basis was less than $3,750 plus $1,250 from the third distribution's ROC, then once basis hits 0, the rest becomes layer 4 capital gain.
Wow. That example really drives home how the timing and the allocation rules interact. The first two distributions were fully taxable dividends. The third was mostly dividend but partly return of capital, and the fourth was half dividend and half return of capital. All because of how current EMP spreads out and accumulated EMP applies chronologically.
Exactly. It underscores why corporations and shareholders need to track EMP and distributions carefully throughout the year. It's not just the year-end numbers that matter.
Okay, switching gears slightly within distributions. What if the corporation tries to pay money to a shareholder but they don't call it a dividend? Maybe they call it a really high salary or excessive rent for property this shareholder owns.
Ah, yes. This is where the concept of constructive dividends comes into play. These aren't formally declared dividends by the board of directors.
They're disguised.
Essentially, yes. The IRS may reclassify payments made to shareholders as dividends if they look and feel like distributions of corporate profits, but are disguised as something else, usually something the corporation could deduct.
Why would the corporation want to disguise it?
Often for tax reasons. If the corporation pays salary or rent, it generally gets a tax deduction for that expense, lowering its own taxable income. But if it pays a dividend, the corporation gets no deduction. Dividends are paid out of after-tax profits.
So the corp wants the deduction.
Right. But the IRS looks at the substance over the form. If a payment seems unreasonable or not really for service property, they can challenge it. The source lists common examples.
Like what?
Excessive salaries paid to shareholder employees paying much more than what's reasonable compensation for the actual work performed in that role and industry.
Okay, unreasonable salary.
Excessive rents or royalties paid to shareholders for using their personal property or intellectual property, again, paying more than fair market rates.
Inflated rents.
Loans made to shareholders that lack the typical features of a real loan. Maybe no formal promissory note, no stated interest rate, no fixed repayment schedule, no real expectation or effort to collect repayment. Looks more like just giving them money.
Fake loans. Got it.
Or selling corporate assets to a shareholder for a price significantly below fair market value. The bargain element, the discount, can be treated as a constructive dividend.
Selling cheap to the owner.
Yep. In all these cases, if the IRS reclassifies the payment, or the excessive portion, as a constructive dividend,
What happens then? Double hit.
it can be. First, the corporation loses the tax deduction it might have claimed for that excessive salary, rent, etc. That increases the corporation's taxable income. Second, the shareholder must treat that reclassified amount as taxable dividend income to the extent of EMP, just like a regular dividend.
Ouch. Lose the deduction, shareholder pays tax. That's the double taxation biting.
Exactly. It highlights the importance of keeping transactions between the corporation and its shareholders at arm's length and properly documented.
Makes sense. Now, what about distributions of the corporation's own stock? If a corporation gives shareholders more shares, a stock dividend, is that generally a taxable event?
Generally speaking, no. A distribution of a corporation's own stock to its shareholders, pro rata, as a stock dividend is typically not a taxable event for the shareholder receiving the stock.
Why not?
The tax system basically sees it as just dividing the existing ownership pie into more smaller slices. If everyone gets more shares proportionally, their percentage ownership in the company usually hasn't actually changed. They just have more pieces of paper representing the same stake.
So, usually tax-free. Is there an exception where a stock dividend is taxable?
Yes, there's a key exception mentioned in the source. A stock dividend is taxable if the shareholder has the option to receive cash or other property instead of the stock.
Ah, if they have a choice.
Right. Even if the shareholder chooses to take the stock, the mere existence of that cash or property option taints the whole distribution and makes the stock dividend taxable to everyone who receives it.
Why does the option make it taxable?
The logic is constructive receipt. If you had the option to take cash instead, the tax system treats it as if you did receive the cash, which would be taxable, and then immediately use that cash to buy the new shares. So the value of the stock received becomes taxable income.
Okay, so if a stock dividend is taxable because of the cash option, how is that value determined for tax purposes? And what's the shareholder's basis in those new taxed shares?
If it's taxable, the amount included in the shareholder's income is the fair market value of the stock on the distribution date. And because they paid tax on that FMV, their basis in those newly received shares is also that same fair market value. Remember, taxable event equals FMV basis.
Right. And if it's non-taxable, like the usual case, common stock dividend on common stock, no cash option, how does that affect basis?
If it's a non-taxable stock dividend and the old shares and the new shares are identical, for example, common on common, the shareholder doesn't recognize any income. Instead, their original total tax basis in their old shares is simply spread out over the total number of shares they hold after the dividend. Old shares plus new shares.
So the total basis stays the same, but the basis per share goes down?
Exactly. The total investment amount hasn't changed, just the number of shares representing that investment, so the cost per share decreases.
The source illustrates this with the Linda Conduff example. Linda bought 100 shares for $18,000 total, so her initial basis was $180 per share. Then she receives a 50% non-taxable stock dividend, getting 50 new shares.
Right. So before the dividend, 100 shares, $18,000 total basis, 180 share. After the non-taxable dividend, she receives 50 new shares, so she now holds 150 shares total. Her original $18,000 total basis is now allocated across all 150 shares.
$18,000 divided by 150 shares. That's $120 per share.
Precisely. Her new basis is $120 per share. Her total basis is still $18,000, but the per-share basis dropped from $180 to $120. This lower per-share basis will be important when she eventually sells any of those 150 shares, as it will result in a larger calculated gain or smaller loss per share compared to the original $180 basis.
Okay, that makes sense for stock dividends. Now, what if the corporation distributes other property instead of cash or its own stock? Like it gives shareholders a piece of land it owns or some equipment as a dividend?
This is where things get a bit more complex, because distributing property other than cash can create tax consequences for both the shareholder receiving the property and the corporation distributing it. That's a key difference.
Okay, let's take the shareholder first. How are they taxed when they receive property as a dividend?
For an individual shareholder, the amount of the distribution is the fair market value of the property received on the date of distribution. That FMV amount is treated as a dividend to the extent the corporation has EMP, following that four-layer waterfall we discussed.
So value of property, potential dividend income, up to EMP.
Right. And the shareholder's tax basis in the property they just received is also its fair market value at the time of distribution. Taxable distribution at FMV leads to FMV basis.
Okay. What about a corporate shareholder receiving property? Same rules.
Generally, yes. The taxable amount is the FMV, up to EMP, and their basis in the property received is the FMV. The main difference is that the corporate shareholder might be eligible for a dividends received deduction, DRD, on that dividend income, which can significantly reduce or even eliminate the tax they pay on it. Individuals don't get a DRD.
Got it. Now, let's look at the corporation paying the dividend. You said distributing property can have tax consequences for them too, unlike just paying cash. How does that work?
It does. While paying a cash dividend generally doesn't create a gain or loss for the corporation itself, distributing property is different. Specifically, if the corporation distributes appreciated property.
Meaning property where the fair market value is higher than the corporation's adjusted basis in it.
Yeah. Exactly. If it distributes appreciated property as a dividend, the corporation must recognize gain as if it had sold that property to the shareholder for its fair market value at the time of the distribution.
A deemed sale again. So the corporation has a taxable gain, FMV minus basis, just for distributing the property.
Precisely. Even though no cash came in, the corporation recognizes gain on that built-in appreciation when the property leaves the corporate solution via a dividend. And, importantly, this corporate-level recognized gain increases the corporation's current EMP.
Ah, so the act of distributing appreciated property can actually create more EMP right before the dividend hits the shareholder.
It absolutely can. Now, what if the corporation distributes depreciated property, where the FMV is less than the basis?
Can they recognize a loss?
Generally, no. The corporation is typically not allowed to recognize a loss when it distributes depreciated property as a dividend. It just disappears from their books, and the shareholder takes it at the lower FMV basis.
So, recognize gain on appreciated property, but no loss allowed on depreciated property distribution. Seems a bit one-sided for the IRS.
It does work out favorably for the government, yes. Gain is triggered, loss is usually denied on distribution.
The source had that interesting passkey sequence about this. What happens if a corporation with, say, 0 EMP distributes appreciated property?
Yes, this scenario perfectly illustrates the interplay. Corporation starts with 0 EMP. It distributes appreciated property. Step 1. The corporation recognizes gain on the distribution, FMV basis. Step 2. That recognized gain creates positive current EMP for the corporation. Step 3. Now, the distribution received by the shareholder, which might have looked like a tax-free return of capital if there was no EMP, is now a taxable dividend to the shareholder, but only up to the amount of that newly created EMP.
Wow. So distributing appreciated property can simultaneously trigger tax at the corporate level and turn what looked like a non-taxable distribution into a taxable dividend for the shareholder.
Exactly. It's a potential trap if you're not careful about the assets you choose to distribute as dividends. Distributing cash avoids this corporate-level gain recognition.
Good to know. Okay, let's talk about stock redemptions next. This is when the corporation buys back its own stock from a shareholder. Is that just treated like the shareholders sold their stock, resulting in capital gain or loss? Or can it be something else?
This is another critical area where the tax treatment can diverge significantly from what you might first expect. It's not always treated as a sale. When a corporation buys back its stock, a redemption, the transaction can be treated in one of two main ways for the shareholder.
Okay, what are the two ways?
Option 1. It qualifies for sale or exchange treatment. If it does, the shareholder calculates capital gain or loss, just like selling stock to a third party, the amount received minus their basis in the redeemed shares.
Capital gain or loss, that's usually preferred, right? Lower rates, basis recovery.
Usually, yes. Option 2. If the redemption doesn't qualify for sale or exchange treatment, it's treated as a regular dividend distribution, taxable as ordinary income to the extent of the corporation's EMP, following that 4-layer waterfall again.
Treated as a dividend. Even though they gave up shares, that seems harsh.
It can be. They get dividend income, and crucially, they don't get to offset the proceeds with the basis of the shares they surrendered. The basis of the surrendered shares usually attaches to their remaining shares, if any, so the distinction between sale treatment and dividend treatment is huge.
Okay, so what determines whether it's treated as a sale or as a dividend? What makes it qualify for sale treatment?
The key factor, as outlined in the source, is whether the redemption results in a meaningful reduction in the shareholder's ownership, interest, and control relative to other shareholders.
A meaningful reduction. How is that measured?
The tax code provides a few specific tests. The most common way it gets treated as a dividend is if the redemption is proportional.
Proportional, meaning everyone sells back the same percentage of their shares.
Exactly. If the corporation buys back, say, 10% of the stock from all shareholders pro rata, it's generally treated as a taxable dividend to everyone. Why? Because after the transaction, even though everyone has fewer shares, they all still own the exact same percentage of the now smaller company. Their relative ownership position hasn't changed at all. It looks economically just like they all received a cash dividend.
Okay, so proportional redemption, dividend treatment. To get that preferred sale or exchange treatment, the redemption needs to be disproportionate.
Correct. A disproportional, or more technically, a substantially disproportionate, redemption qualifies for sale or exchange treatment. The source gives us specific mathematical tests for this.
Okay, what are the tests?
Two tests must both be met immediately after the redemption. First, the shareholder's percentage ownership of the total outstanding voting stock must be less than 50%.
Below 50% ownership after. Got it.
And second, their percentage ownership after the redemption must be less than 80% of their percentage ownership before the redemption.
Less than 80% of their prior ownership percentage. Okay, so a significant drop.
Right. If both the under 50% test and the under 80% of prior ownership test are met, it qualifies as substantially disproportionate, and the shareholder gets sale or exchange, capital gain loss, treatment.
What if you're trying to meet those tests, like getting below 50% or dropping your percentage significantly, but your family members also own stock in the same C Corp? Does their stock count toward your ownership for these tests?
Yes, that's a very important catch. For these redemption tests, especially this substantially disproportionate one, complex family attribution rules apply. Stock owned by your spouse, children, grandchildren, and parents is generally considered to be owned by you when calculating your ownership percentages before and after the redemption.
Oh, wow. So if my spouse owns 30% and I own 30%, the IRS sees me as owning 60% for these tests.
Generally, yes. These attribution rules can make it much harder to meet the substantially disproportionate tests in closely held family businesses because redeeming only your shares might not reduce the attributed ownership percentage enough.
Yikes. Is there any way around that? What if you want to completely get out of the business and sell all your shares back to the corporation, but your kids still own stock? Can you still get sale treatment?
Yes. Thankfully, there's a crucial exception highlighted in the source: a complete termination of a shareholder's interest. If the corporation redeems all of the stock actually and constructively owned by a shareholder, with some ability to waive family attribution under specific rules, it's treated as a sale, providing capital gain or loss treatment.
Even if family members still own stock?
Yes, if you meet the requirements for waiving family attribution, like agreeing not to reacquire an interest for 10 years and filing a notice with the IRS. A complete termination allows you to get sale treatment and make a clean break, tax-wise.
That's a really important out for family businesses. Are there any other situations where a redemption gets sale treatment?
The source mentions a few others. A redemption in partial liquidation of the corporation's business. This usually applies only to non-corporate shareholders. Also, redemptions that are deemed not essentially equivalent to a dividend. This is a more subjective facts and circumstances test, looking for a meaningful reduction in interest, even if the strict mathematical tests aren't met. And finally, redemptions made specifically to pay estate taxes or funeral and administrative expenses after a shareholder dies, subject to certain limits tied to the value of the stock in the estate.
Okay, so the big takeaway on redemptions is, unless it significantly reduces your ownership, disproportionate, or eliminates it entirely, complete termination, it's likely going to be taxed like a dividend, not a sale.
That's the general rule of thumb, yes. Be very careful with pro rata redemptions.
All right, we've covered forming the business, getting money out while it's running, what happens at the very end. When the whole C Corp journey concludes and the corporation winds down completely, liquidates.
This is often where the C corporation structure faces its most significant potential tax downside. The infamous double taxation really hits hard upon liquidation.
Double taxation again. How does that work in liquidation?
Unlike pass-through entities like S-Corp or partnerships, where gains generally only flow through once, when a C corporation liquidates, the source material makes it clear that both the corporation itself and the shareholders generally recognize gain or loss on the transaction.
Both sides pay tax. Ouch.
It can be painful. The source does note, as a small silver lining, that the expenses the corporation incurs in the process of liquidating are deductible on its final tax return.
Okay, so how does this double tax actually play out? The source mentions two common ways a C Corp might liquidate.
Right. Method one is where the corporation sells all its assets to outside buyers, pays off its debts, and then distributes the remaining cash to the shareholders.
Okay, sell assets, then distribute cash. Where's the tax?
2 levels. First, the corporation recognizes gain or loss on the sale of each asset it sells. That's calculated as the sale price minus the corporation's adjusted basis in the asset. This corporate-level gain or loss is reported on the corporation's final tax return and taxed at corporate rates.
That's tax number one.
Then, after the corporation pays its taxes and any remaining debts, it distributes the net cash to the shareholders in exchange for their stock. The shareholders then recognize gain or loss based on the cash proceeds they receive minus their basis in their stock. This shareholder-level gain or loss, usually capital gain loss, is taxed on their individual returns.
That's tax number 2.
Okay.
What's the second method of liquidation?
The second method is where, instead of selling assets for cash first, the corporation distributes its assets directly to the shareholders. Maybe they want to continue part of the business personally, or maybe the assets are hard to sell quickly.
So they just hand over the land, equipment, etc. to the owners. How is that taxed? Still double.
Still double, yes. It works similarly using deemed sales. First, the corporation recognizes gain or loss as if it had sold those assets to the shareholders for their fair market value at the time of distribution.
Another deemed sale at the corporate level. FMV minus basis. Corporate gain loss. Tax #1.
Correct. That gain or loss is taxed to the corporation. Then the shareholders, upon receiving these assets, recognize gain or loss based on the fair market value of the assets they received versus their basis in their stock. FMV of assets received stock basis, shareholder gain loss.
And that's tax #2. So basically, whether the corporation sells the assets first or distribute them directly, you generally trigger a tax at the corporate level on the appreciation of the assets, and then another tax at the shareholder level on the appreciation of their stock value received in liquidation.
That's the essence of the double tax on C Corp liquidation. The source also notes that when assets are distributed directly, the shareholders' basis in those assets going forward is generally their fair market value at the time of distribution, since that's the value they were taxed on receiving.
Okay, liquidation sounds potentially quite costly from a tax perspective. But not all corporate endings involve just shutting down and liquidating, right? What about things like mergers or acquisitions where one company buys another, or maybe splitting a big company into smaller ones?
Exactly. Those kinds of transactions, when structured correctly, can often qualify as tax-free reorganizations. This is a completely different path than liquidation.
Tax-free. Why can those be tax-free when liquidation is so heavily taxed?
The fundamental reason, as the source highlights, is based on the idea of continuity. In a qualifying reorganization, the shareholders haven't truly cashed out their investment in the way they do in a liquidation. Instead, they've continued their investment just in a modified form of the business.
So they swap stock in old co for stock in new co or acquiring co.
Essentially, yes. They maintain a continuing equity interest. This continuity of business enterprise and continuity of interest are key requirements for tax-free reorganization treatment.
The tax code has these specific definitions for different types of reorganizations, using letters like type A, B, C, and so on.
It does. These are specific statutory frameworks that a transaction must fit into to get the tax-free status. For example, a Type A reorganization is typically a statutory merger or consolidation under state law. Two companies blend into one or form a new combined company.
Okay. A is merger consolidation.
A Type B is a stock-for-stock acquisition. One corporation acquires control, that 80% threshold again, of another corporation solely by exchanging its voting stock for the target corporation's stock. No boot allowed generally in a B reorg.
B is stock for stock voting.
A Type C is a stock for assets acquisition. One corporation acquires substantially all of the assets of another corporation in exchange primarily for its voting stock, though a little boot is sometimes permissible here.
C is stock for assets.
And there are others. Type D covers certain transfers to controlled corporations, often used in divisive reorganizations, like spinning off a subsidiary. Type E is a recapitalization, reshuffling the capital structure of a single corporation. Type F is a mere change in identity, form, or place of organization. Fitting the deal into one of these defined boxes is crucial for tax-free treatment.
Okay. And if a transaction does qualify as one of these reorganizations, what are the tax consequences for the corporation and the shareholders?
Generally very favorable compared to liquidation. For the corporations involved, the reorganization transaction itself is typically non-taxable. A huge benefit is that the tax attributes of the old or acquired corporation, things like net operating losses, NOLs, capital loss carryovers, E&P accounting methods, usually carry over to the new or surviving corporation.
So valuable tax assets aren't lost.
Exactly, they're preserved. For the shareholder, the exchange of their old stock for new stock in the reorganization is also generally non-taxable. Instead of recognizing gain or loss, the shareholder simply takes their original basis from their old stock and applies it to the new stock they receive. It's a basis carryover, similar to Section 351 formation.
Basis carryover for the shareholder, tax attributes carryover for the corp. Sounds good. But is there a boot exception here too? What if the shareholder gets some cash or other property in addition to stock in the reorganization?
Yes, absolutely. Boot complicates things here too. If shareholders receive boot cash, debt securities, other non-stock property as part of the reorganization exchange, they do recognize gain.
Ouch, can.
The amount of recognized gain is limited to the lesser of the shareholder's total realized gain on the overall exchange or the amount of boot received. So the stock-for-stock part remains tax-free, but any value cashed out via boot becomes taxable gain up to the total gain inherent in their old shares.
Lesser of realized gain or boot received. Same rule as Section 351 boot. Okay. And you mentioned that control concept pops up again in reorganizations.
Yes, the source points out that control, often using that same 80% ownership threshold, voting power, and all other classes of stock, is a key requirement for certain types of reorganizations, particularly Type B, stock for stock, and some Type D, divisive reorganizations. It reinforces that idea of continued control and investment being central to the tax-free treatment.
The source had a really powerful passkey table that contrasted liquidation versus reorganization. Can you summarize that?
It's a great way to see the stark difference, liquidation. The business activity completely ceases, at least in that corporate shell. The tax result, generally taxable for both the corporation on asset appreciation and the shareholder on stock appreciation value received. That double tax hit.
Liquidation, business stops. Taxable for both.
Reorganization. The business activity continues, just in a modified corporate form. The tax result. Generally non-taxable for both the corporation and the shareholder, except for any boot received by the shareholder. Tax attributes carry over, basis carries over.
Reorganization, business continues, non-taxable mostly. Big difference.
Huge difference in tax outcome, driven by whether the business continues or stops.
Now, is there an exception to the usually taxable liquidation rules? What about liquidating a subsidiary company into its parent company?
Yes, that's a very important exception discussed in the source, often called a parent-subsidiary liquidation, or Section 332 liquidation. If a parent corporation owns at least 80% of the stock, both voting power and value of a subsidiary corporation, the complete liquidation of that subsidiary into the parent is generally a non-taxable event for both the parent corporation and the liquidating subsidiary.
Non-taxable for both if the parent owns 80% plus.
Correct. The parent corporation receives the subsidiary's assets and liabilities tax-free. The subsidiary generally doesn't recognize gain or loss on distributing its assets up to the parent. And importantly, the parent corporation takes a carryover basis in the subsidiary's assets. It steps into the sub's shoes for basis and also inherits the subsidiary's tax attributes, like NOLs, E&P, etc.
So it's treated much more like a reorganization than a regular taxable liquidation.
Exactly. It facilitates tax-free consolidation of business operations within a controlled group. Very different from liquidating a C Corp owned by individuals.
Okay, that wraps up the life cycle events. Let's shift focus now to some special rules related to specific types of stock investments in C corporations. What happens if you invest in a small business stock that doesn't pan out, and you sell it at a loss or it becomes completely worthless? Is there any special tax break for that kind of loss?
Yes, there potentially is, and it can be quite beneficial. It relates to something called Section 1244 stock.
Section 1244.
The source explains that if stock qualifies as Section 1244 stock, and an original stockholder, meaning someone who acquired the stock directly from the corporation, not by buying it from another shareholder, sells that stock at a loss, or if it becomes worthless.
Yes. What happened?
They can treat that loss as an ordinary loss for tax purposes, rather than the usual capital loss you get from selling stock.
Ordinary loss instead of capital loss. Why is that better?
It's usually much, much better. Ordinary losses can generally be deducted fully against any type of ordinary income. You have like salary, business income, interest, etc. in the year the loss occurs, subject to an annual limit. Capital losses, on the other hand, are much more restricted.
How are capital losses restricted?
Capital losses must first be used to offset any capital gains you have in the same year. If you still have capital losses left over after offsetting gains, you can only deduct a maximum of $3,000 per year, $1,500 if married filing separately, against your ordinary income. Any excess capital loss beyond that $3,000 annual limit has to be carried forward to future years.
So getting an ordinary loss deduction under Section 1244 means you can potentially deduct a lot more loss against your regular income in the current year compared to the $3,000 limit for capital losses.
Exactly. It provides much faster and potentially larger tax relief for a failed small business investment.
Is there a limit to how much loss can be treated as ordinary under Section 1244 in 1 year? You mentioned an annual limit.
Yes, there is. The source specifies the maximum ordinary loss deduction you can take under Section 1244 per taxpayer per year. For single individuals or those married filing separately, the limit is $50,000 per year. For taxpayers who are married and file a joint return, the limit is doubled to $100,000 per year.
$50K, single $100K joint annual limit for ordinary loss treatment. What happens to any loss above that limit in a given year?
Any Section 1244 loss that exceeds those annual ordinary loss deduction limits, 50K, 100K, is then treated as a regular capital loss, subject to the normal capital loss rules. Offset gains, $3K limit against ordinary income carry forward.
Okay, so it's a significant benefit up to that limit. What makes stock qualify as Section 1244 stock? Are there specific requirements for the corporation or the stock issuance?
Yes, several key qualifications detailed in the source. First, the stock must have been issued by a domestic C corporation in exchange for money or other property. Stock issued for services doesn't qualify.
Issued for cash or property, not services.
Second, and this is a big one, at the time the stock was issued, the total amount of money and property received by the corporation for its stock as a contribution to capital and as paid in surplus could not exceed $1 million. This is why it's often called small business stock. It targets the initial capitalization phase.
So the corporation must have had less than $1 million in total capital when the stock was issued.
Correct. That's the threshold test at the time of issuance for the stock to potentially qualify. And third, as we mentioned, the loss must be claimed by the original individual shareholder or a partner in a partnership that was an original shareholder who acquired the stock directly from the corporation. If you buy the stock later on the secondary market, it loses its Section 1244 character for you.
Original owner, cash property, under $1 in capital test. Got it. That's a nice potential cushion if a small biz investment fails.
Yeah.
Now let's flip the coin. What if an investment in a small C corporation is a massive success? You hold the stock for years, it appreciates immensely, and then you sell it. Is there any special tax break on the gain side?
Yes, and this one can be even more valuable. It falls under the Qualified Small Business Stock, or QSBS rules, sometimes referred to by its code section, Section 1202.
QSBS, or Section 1202.
Okay.
What's the potential benefit?
The source states that a non-corporate shareholder, so individuals, partnerships, S-corp, estates, trusts, but not C-corp, who holds qualified QSBS for more than 5 years, may generally exclude, get this, 100% of the gain realized on the sale or exchange of that stock.
100% exclusion of the gain. You mean potentially zero tax on the profit?
That's exactly what it can mean, up to certain limits. It's a huge incentive for long-term investment in qualifying small businesses.
Wow. You mentioned limits. Is there a cap on how much gain can be excluded per investment?
Yes, there is a maximum exclusion amount per qualifying shareholder per qualifying corporation. The amount of gain eligible for the 100% exclusion is limited to the greater of 2 figures. Either 10 times the taxpayer's adjusted basis in the specific QSBS stock being sold, or $10 million, $5 million if married filing separately.
Greater of 10x basis or $10 million per company. That's still a massive potential exclusion.
It really is. It can shelter very significant gains from any federal income tax. Any gain that exceeds this maximum exclusion limit, the greater of 10x basis or $10 MRs, is then taxed at the regular applicable capital gains rates.
Okay, so what makes stock qualified small business stock? What are the hurdles to clear for this amazing benefit? The qualifications must be pretty specific.
They are quite specific, and you need to meet all of them as detailed in the source.
Oh yeah, lay them out for us.
First, the stock must have been originally issued by the corporation ever August 10, 1993. That's when the law was enacted.
Okay, issued post-August 93.
Second, similar to Section 1244, the shareholder claiming the exclusion must have acquired the stock at its original issuance directly from the corporation or through an underwriter, not by purchasing it later from another shareholder.
Original issuance again.
Third, the issuing corporation must be a domestic C corporation. S corporations do not qualify for issuing QSBS. The entity must be a C corp during substantially all the shareholders' holding period.
Must be a C corp, not an S corp.
Yeah.
That's a key planning point.
Absolutely. Fourth, the small business part. As of the date the stock was issued, and immediately after the issuance, the corporation's aggregate gross assets must have been $50 million or less. This includes cash and the adjusted basis of property held, though for contributed property, it's FMV at contribution.
$50 million asset test at the time of issuance. Higher threshold than the $1 for 1244.
Much higher, yes. Allows for more established companies to qualify initially. Fifth, the active business requirement. During substantially all of the shareholders' holding period, at least 80% of the value of the corporation's assets must be used by the corporation in the active conduct of one or more qualified trades or businesses.
Active qualified trade or business. Are there businesses that don't qualify?
Yes, the law specifically excludes several types of businesses from being qualified. This includes most service businesses in fields like health, law, engineering, architecture, accounting, actuarial science, performing arts, consulting, athletics, financial services, or brokerage services. Also excluded are banking, insurance, financing, leasing, investing, farming, mining, and operating hotels, motels, or restaurants.
Wow, that excludes quite a lot, especially in the service sector.
Yeah.
So QSBS is more targeted towards manufacturing, technology, retail, wholesale.
Generally, yes. Businesses developing or selling products, technology, software, those often fit more easily. It's crucial to verify the active qualified business requirement. And sixth, the shareholder must hold the stock for more than 5 years to get the exclusion.
More than 5 years holding period. Okay. Original issue, C Corp, under $50 assets at issue, active qualified business, held over 5 years. That's a lot of hoops, but the payoff 100% gain exclusion up to $10 or 10x basis is incredible.
It really is one of the most powerful tax incentives available for long-term investment in qualifying startups and growth companies structured as C Corp.
Fantastic. Okay, one final area to cover. Loans between the corporation and its shareholders. We know shareholders might lend money to the corporation, maybe to help with cash flow, or the corporation might lend money to a shareholder, perhaps as an advance. What's the big tax issue to watch out for here besides just, making sure it's a real loan?
The key issue, which the source material highlights, revolves around the interest rate charged on these loans. The IRS generally requires that loans between related parties, like a corporation and its shareholder, carry an interest rate that is at least equal to an objective market rate. The benchmark they use for this is the applicable federal rate, or AFR.
AFR, the applicable federal rate, that's set by the IRS.
Yes, the IRS publishes these rates monthly based on the average market yields on outstanding U.S. government obligations, short-term, mid-term, long-term. If a loan is made between a corporation and a shareholder at an interest rate below the appropriate AFR for the term of that loan.
A below-market loan.
Right. If it's a below-market loan, then the imputed interest rules may kick in.
Imputed interest, what does that mean? These pretend interest was paid.
Essentially, yes. Imputed interest is the difference between the interest that should have been charged according to the AFR and the interest that was actually charged, which might be zero. The tax system treats this difference, this foregone interest, as if it was paid by the borrower to the lender and then immediately transferred back from the lender to the borrower.
Paid and then returned. How does that work?
The source gives a simple example. Imagine the corporation makes a $100,000 loan to a shareholder and charges zero interest. Let's say the applicable AFR for that type of loan is 3%. The imputed interest for the year would be $3,000, $100,000, 3%. The tax system acts as if the shareholder paid $3,000 in interest to the corporation.
Okay, shareholder pays 3-day interest.
And then the corporation immediately transferred that same $3,000 back to the shareholder.
As what? What's the nature of that transfer back?
That's the crucial part. The tax consequences depend on the relationship and the direction of the loan. The source focuses on the common scenario where the corporation makes the below-market loan to the shareholder. In this case, that imputed interest amount, the $3,000 the corporation is deemed to have transferred back to the shareholder, is often treated as a dividend from the corporation to the shareholder.
Ah, so the shareholder borrower has $3,000 of taxable dividend income, even though no actual cash interest changed hands.
Exactly. To the extent the corporation has E&P, the shareholder gets taxed on the economic benefit they received from the cheap loan, characterized as a dividend.
What if the shareholder who got the loan is also an employee? Could that imputed transfer back be treated as compensation instead of a dividend?
It could be, yes. If the shareholder is also an employee, the imputed interest might still be treated as a dividend, especially if their stock ownership is the dominant reason for the loan. However, if the below-market loan is clearly tied to their role as an employee and considered part of their compensation package, the imputed amount transferred back could potentially be treated as taxable compensation income to the employee and potentially deductible compensation expense for the corporation, unlike a dividend.
So it could be dividend or compensation. But either way, the shareholder has imputed taxable income from the benefit of the below-market loan.
That's the main takeaway. The tax system won't let that economic benefit slide. It recharacterizes the foregone interest as a taxable transfer, usually a dividend when the corporation lends to the shareholder. The corporation, in turn, might have imputed interest income that it has to recognize from the interest the shareholder was deemed to pay. It just creates unnecessary complexity and potential tax traps.
So the simple solution is,
Just charge interest at or above the applicable federal rate on any loans between the corporation and its shareholders, document it properly as a loan, and actually make the payments. It avoids all these imputed interest headaches.
wow, okay. That was a really comprehensive journey through the key financial and tax interactions between C corporations and their owners. We covered a lot of ground for the tax-free potential and pitfalls of Section 351 formation.
Right, the basis rules, the boot, the liabilities.
The absolute centrality of earnings and profits, E&P, in determining how distributions are taxed, that whole four-layer waterfall.
Current E&P, accumulated E&P, return of capital, capital gain. Yep.
The complexities of constructive dividends, stock dividends, property dividends, triggering corporate gains,
The deemed sale rules.
stock redemptions, and whether they're treated as a sale or a dividend based on proportionality.
Huge difference there.
The potential double tax hammer blow on liquidation versus the tax-free continuation of reorganizations.
Continuity being the key.
And these fascinating special rules for small business stocks, Section 1244 for ordinary losses, and QSBS for potentially tax-free gains.
Incredible benefits if you qualify.
And finally, the imputed interest trap on below-market loans.
Right.
It's clear there's just a deep level of detail and very specific rules governing every single step of this relationship.
Exactly right. And these aren't just, theoretical tax concepts cooked up in textbooks. They have profound real-world implications for how much tax gets paid, when it gets paid, and ultimately the overall financial return for anyone owning or investing in a C corporation.
Absolutely.
Understanding things like how liabilities affect basis, how to correctly source distributions using those E&P netting rules, knowing the difference between a redemption treated as a sale versus one treated as a dividend, or being aware of the incredible potential of that QSBS gain exclusion, it's all absolutely crucial for making informed decisions.
So what does all this really boil down to? It just highlights, for me, the absolute necessity of understanding the structure of these transactions and paying close attention to the numbers, things like tax basis, E&P levels, ownership percentages, because those details fundamentally determine the tax outcome. It really underscores that while the C Corp structure offers certain advantages, like that strong limited liability shield or maybe easier access to certain types of capital, it definitely comes bundled with some unique tax complexities, particularly around getting profits out to the owners and eventually winding things down or selling.
That's a perfect summary. And it naturally leads to a pretty important question, I think. Considering all the complexity we've just discussed, especially that potential for double taxation on distributions and liquidation, and the intricate rules compared to the relative, maybe, simplicity of pass-through entities like S-corp or partnerships,
Yeah.
how heavily should these specific tax factors weigh into that initial fundamental decision of choosing a C corporation structure versus another entity type when someone is first starting a new business?
That is a really good question to mull over. How much should the tax tail wag the business dog at the outset? Something to think about. Thanks for joining us on this deep dive.